Before we dive in, a quick but important disclaimer. I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The process and options shown are based on my own research and experience navigating these systems, and they are not a substitute for professional, personalized advice. Insurance rates are incredibly specific to your individual situation, including your location, driving history, and vehicle. So please use this video as a guide to empower yourself, but always do your own due diligence and consult with a qualified professional to find the best policy for your unique needs. You get that email, the one that makes your stomach clench just a little bit. The subject line reads, "Your auto insurance policy is about to renew." And you just know before you even open it what's inside. That number, the one you've been paying for 6 months or a year, is going to be bigger. It always is. You haven't had an accident. You haven't gotten a single ticket. You're driving the same car on the same roads to the same job, but somehow your loyalty is being rewarded with a price hike. It feels like you're trapped in a subscription you can't cancel, paying a fee that only ever goes in one direction. Up. Feels unfair. Feels frustrating. And for millions of Americans, it feels completely out of their control. But what if I told you that feeling of helplessness is by design? What if the confusion and the sheer hassle of switching is the insurance industry's greatest weapon for keeping your money? A recent study found that nearly half of all American drivers are likely overpaying for their car insurance, with the average overpayment being over $400 per year. $400. Think about what that is. That's a plane ticket. It's a new set of tires. It's a significant chunk of a credit card bill, just vanishing from your account every year simply because of inertia. Because the process of shopping for a new quote seems so daunting, so complicated, and so full of traps that it's easier to just sigh, accept the rate increase, and move on. Well, today that ends. Today we are pulling back the curtain and taking back control. This video is your definitive step-by-step masterclass on navigating the online quote process for one of the largest insurers in the United States, Progressive. We are not just going to fill out a form. We are going to dismantle it piece by piece. I will be your guide through every single screen, every question, every drop-down menu. I'm going to show you not just what to click, but why you're clicking it. We'll expose the trick questions designed to put you in a higher risk category. We'll uncover the hidden discounts that most people fly right past. We'll demystify the jargon like comprehensive, collision, bodily injury liability, and uninsured motorist coverage, so you understand exactly what you're buying, and more importantly, what you're not. By the time this is over, you will have a real, actionable quote in your hands, and you will have the confidence and the knowledge to know if it's a good deal. You will be armed with the information to make a smart, empowered decision, whether that means switching to Progressive or taking your new quote back to your current insurer and demanding they match it. The power will finally be back in your hands. Now, why Progressive? Simple. They are a giant in the industry, which means millions of you are either with them now or will consider them. But more importantly, their online quote engine is one of the most comprehensive and detailed tools out there. It's a perfect training ground. The questions they ask, the information they require, the way they structure their coverages. It's a blueprint for the entire industry. If you can master the Progressive quote process, you can confidently get a quote from Geico, Allstate, State Farm, or any other major carrier. The skills you learn here are universal. We're going to break this down into a meticulously detailed walkthrough. We'll start with the absolute basics. Your name, your address, your vehicle. But we'll go deeper. What happens if you have a custom part on your car? What if you use your car for a side hustle like DoorDash or Uber? How do you add a new driver like a teenager who just got their license without your rates exploding? We'll talk about the VIN, why it's so important to use it, and what the system is looking for when you enter it. Then we'll move into the driver information section. This is where the real mind games begin. They'll ask about your occupation, your level of education, your marital status. It might seem invasive, but each question is a data point feeding a complex algorithm that's calculating your risk. I'll explain the logic behind these questions. We'll talk about driving history. What do you do if you have a minor fender bender from 2 years ago? Or a speeding ticket from 4 years ago? When do you have to disclose it, and when does it fall off your record? Getting this part right can be the difference between a standard rate and a preferred rate, and that difference is measured in hundreds of dollars. And then comes the main event, the coverages. This is the part that makes most people's eyes glaze over. It's a wall of numbers and legal terms, but we are going to make it simple. I'll give you real-world examples. What does 25/50/25 liability actually mean in a real accident? Do you really need rental car reimbursement? Is roadside assistance through your insurance a good deal? Or are you better off with something like AAA? We will explore Progressive's signature features, like the Name Your Price tool. Is it a gimmick? Or a genuinely useful way to build a policy that fits your budget? We'll look at Snapshot, their telematics program that tracks your driving. We'll discuss the pros and cons, the potential for huge savings, and the privacy concerns you need to consider before you agree to plug that little device into your car. This isn't just about saving money, it's about understanding what you are paying for. Your auto insurance policy is one of the most important contracts you'll ever sign. It's the only thing standing between you and potential financial ruin, if you're ever in a serious accident. A cheap policy with lousy coverage isn't a bargain. It's a liability. My goal is to show you how to find the sweet spot, the best possible coverage at the lowest possible price. So if you're ready to stop feeling like a victim of automatic rate increases and start feeling like the savvy consumer you are, you're in the right place. I encourage you to follow along. Open up a new tab in your browser, go to the Progressive website, and let's do this together side by side. The single best tool you can have right now is a copy of your current insurance policy's declaration page. That's the document that lists all your current coverages and costs. If you don't have it, pause this video, log into your current insurer's website and download it. It will be your cheat sheet and your baseline for comparison. Let's get started on the first page of the quote. The basics of you and your vehicle. Let's begin the journey from being an insurance customer to being an insurance master. Alright, the very first thing you'll see front and center is a field asking for your zip code. This isn't just for their mailing list. This single 5-digit number is arguably the most powerful factor in determining your initial rate, even before they know who you are or what you drive. Why? Because insurance is a game of statistics, and your zip code tells them a story. It tells them about the population density, the number of accidents per capita in your area, the crime rates, specifically auto theft and vandalism. It tells them about the weather patterns. Do you live in a hail-prone area of Texas or the snowy plains of Minnesota? It even tells them about the quality of your local roads and the likelihood of hitting a deer or a pothole. You are immediately placed into a risk pool with all your neighbors. If you live in a quiet, rural area with wide-open roads, your base rate will start lower than someone living in a dense urban center like downtown Los Angeles or Chicago, where fender benders are a daily occurrence. There's nothing you can do to change this factor short of moving, but it's critical to understand that this is the foundation upon which your entire quote is built. After you pop in that zip code and hit Get a Quote, you're taken to the vehicle information page. This is where we start feeding the beast the specifics. Your make model. Seems simple, right? But here's your first pro tip. Be precise. Don't just put Ford F-150. Is it an XL, an XLT, a Lariat, a King Ranch? The trim level matters. A higher-end trim often has a more powerful engine, more expensive parts to replace, and sometimes more advanced safety features. All of these details slightly nudge your rate up or down. The system will usually have a drop-down menu to help you find the exact version of your car. Take the extra 10 seconds to get it right. Now for the big one, the VIN, or Vehicle Identification Number. Progressive, like most insurers, will strongly encourage you to enter it. You should absolutely do it. Don't skip this. The VIN is the 17-character DNA of your car. It's a unique code that tells the insurance company everything it needs to know, with zero ambiguity. It confirms the exact year, make, model, and trim. But it goes deeper. It tells them the engine size, the type of transmission, where the vehicle was manufactured, and most importantly, it unlocks a detailed list of all the factory-installed safety features. Does your car have anti-lock brakes? Electronic stability control? Front and side curtain airbags? The VIN tells them instantly. Manually telling the system you have these features is good, but letting the VIN do it is foolproof. It proves you have them, which can unlock discounts you might not even know existed. You can find your VIN on your current insurance card, your vehicle registration, or by looking through the driver's side of your windshield, right at the corner where it meets the dashboard. Using the VIN ensures accuracy and maximizes your potential for safety-related discounts right from the start. Next up, you'll be asked a seemingly innocent question. What do you primarily use this vehicle for? The typical options are commuting, pleasure, or business/farm. This is not a trick question, but your answer has significant weight. Let's break it down. Pleasure use means you don't use the car for a regular commute to work or school. This is for retirees, stay-at-home parents, or people who work from home and mainly use their car for errands, weekend trips, and social visits. This is generally the lowest risk and therefore the cheapest category. Commuting means you use the car to drive to and from work or school on a regular basis. This automatically signals to the insurer that the car is on the road during the busiest, most accident-prone times of day, rush hour. This adds risk, and your premium will reflect that. Finally, there's business or farm use. This is for people who use their vehicle as an integral part of their job. Think real estate agents driving clients, contractors hauling tools and materials, or delivery drivers. This is the highest risk category because the car is on the road far more often in unfamiliar areas, and under time pressure, which statistically leads to more claims. Be honest here. It can be tempting to select pleasure to get a lower rate. But if you get into an accident during your morning commute, and the insurance company discovers you misrepresented the vehicle's use, they could have grounds to deny your claim entirely. That's a catastrophic risk for a few dollars in savings. Tied directly to vehicle use is the question of annual mileage. The logic is simple. The less you drive, the less exposure you have to accidents. A car that's on the road for 5,000 miles a year is statistically far less likely to be in a wreck than one driven 20,000 miles a year. But how do you accurately estimate this? Don't just guess. Do some quick math. Figure out your daily round-trip commute. Let's say it's 20 miles. Multiply that by the number of days you work a week, say 5. That's 100 miles per week. Multiply that by the number of weeks you work a year, let's say 50. That's 5,000 miles just for commuting. Now add in your weekend and errand driving. A good rule of thumb is to add another 50 to 100 miles per week for that. So, let's say 75 miles times 52 weeks is 3,900 miles. Add that to your 5,000 commute miles, and you're at 8,900 miles per year. It's better to slightly overestimate than to drastically underestimate. Insurers have massive amounts of data. They know what the average mileage is for someone in your zip code with your job. If your estimate is wildly out of line, it could raise a red flag. Also, remember that services like Carfax and state vehicle inspections often record your mileage, creating a historical record. Again, honesty is crucial. If you're a very low mileage driver, this is a fantastic opportunity to save money. It might even make you a candidate for a pay-per-mile insurance program, which is something to consider down the line. The final pieces of the vehicle puzzle are ownership and garaging. First, do you own, finance, or lease the vehicle? If you've paid it off completely, you own it. If you have a car loan, you're financing it. If you're making monthly payments to use the car for a set term, you're leasing it. Why does this matter? Because if you are financing or leasing, the lien holder or leasing company, the bank that actually owns the car, has a vested interest in protecting their asset. They will almost certainly require you to carry full coverage, meaning both collision and comprehensive with specific low deductibles. If you own the car outright, especially if it's an older, less valuable car, you have the freedom to choose whether or not to carry those coverages, which can save you a lot of money. We'll dive deep into coverages later, but your answer here sets the stage for those future decisions. Lastly, the garaging address. This is the address where your vehicle is primarily parked overnight. For 99% of people, this is simply your home address. But it's a separate question because for some, it's different. Think of a college student who lives at a dorm for 9 months of the year, or a construction worker on a long-term project in another state. The garaging address needs to be the location where the car actually lives. This ties back to that all-important zip code risk. If you live in a safe suburban zip code but park your car overnight in a high-crime urban center, the insurer needs to know that to accurately price the risk of theft or vandalism. Misrepresenting your garaging address to get a cheaper rate from a parent's home in the suburbs, a practice sometimes called rate evasion, is a form of insurance fraud and can lead to a canceled policy and denied claims. Just be straightforward and list the address where the car spends most of its nights. We've now built a complete profile of the vehicle itself. We've told the system what it is, how it's used, how much it's used, and where it lives. The computer now has a clear picture of the car's risk. But a car is just an object. It doesn't drive itself. The next step is to introduce the single most important and unpredictable variable in the entire insurance equation: the human being who will be sitting behind the wheel. This is where we start talking about you, the driver. And this is where the algorithm truly begins to analyze, judge, and calculate the real cost of your policy. So you've entered your car's information. The system knows its make, model, and VIN. It knows its history, its safety features, and where it sleeps at night. But now we pivot. We move from the cold, hard steel of the machine to the most unpredictable, most complex, and most critical variable in the entire insurance equation: the human being who will be sitting behind the wheel. This is where we start talking about you, the driver. And this is where the algorithm truly begins to analyze, judge, and calculate the real cost of your policy. The driver information section is the heart of the quote. It's the personality test. It's the background check. Everything up until this point was just setting the stage. Now you're the star of the show, and the spotlight is intense. Progressive, and every other insurer, is about to ask you a series of deeply personal questions. And it's not because they're nosy. It's because for the last 100 years they have been collecting data, trillions of data points that connect who you are with how you drive. Every single question is a key that unlocks a different statistical probability about your future behavior on the road. Let's start with the basics. Your name, your date of birth. Simple enough, right? But even here the gears are turning. Your date of birth is one of the most powerful rating factors in the entire system. It's not just about your age. It's about which statistical risk bracket you fall into. A 16-year-old driver is, statistically speaking, an entirely different species from a 46-year-old driver. The 16-year-old has less experience, a less developed prefrontal cortex for judging risk, and a higher statistical likelihood of being involved in a serious accident. The data is brutal and unforgiving on this point. So, when you enter that date, the algorithm immediately pulls up a massive chart of risk, and your premium starts on a foundation built entirely on that number. As you age, your rates typically drop, bottoming out in your 40s and 50s, the so-called golden years of insurance rates, before beginning a slow climb back up as you enter your late 60s and 70s, when reflexes can slow and accident frequency statistically begins to rise again. Next, they'll ask for your gender. Now this is a controversial one, and it's changing. Historically, young men paid significantly more than young women because statistically they were involved in more frequent and more severe accidents. However, several states like California, Hawaii, and Massachusetts have banned the use of gender in setting car insurance rates, viewing it as discriminatory. But in states where it is allowed, it can still have a noticeable impact, especially when you're under 25. Then comes a question that feels like it's straight from a dating app. What is your marital status? Single, married, divorced, widowed? Why on earth does an insurance company care about your love life? Again, it's all about the data. Decades of actuarial tables show a clear, undeniable correlation. Married people get into fewer accidents. The theory is that marriage is a sign of stability and responsibility. A married person is statistically more likely to be home on a Saturday night than out at a bar. They might have kids in the car, making them a more cautious driver. It sounds old-fashioned, it sounds like a stereotype, but the numbers back it up. So if you click married, you will almost always see a discount appear. Insurers see you not as a lone wolf, but as part of a stable pack, and they reward you for it. Now we get even more personal. Your occupation. What do you do for a living? This seems completely unrelated to driving, but to an insurer your job tells a story. Are you a software engineer who works from home 5 days a week? Your risk is incredibly low. Your car barely moves. But what if you're a traveling salesperson, an Uber driver, or a real estate agent? Your job is driving. You're on the road all day, navigating traffic, dealing with deadlines, increasing your exposure to potential accidents exponentially. The algorithm knows this. It categorizes jobs into risk tiers. A librarian, for example, is seen as a very low risk. A pizza delivery driver? Extremely high risk. They even factor in things like stress. An air traffic controller might not drive for work, but the high-stress nature of the job is a data point that, in some complex models, can be correlated with more aggressive driving habits. It's a fascinating and slightly terrifying look into how they profile you based on your career. Then comes your living situation. Do you own or rent your home? This isn't about judging your wealth. It's another proxy for stability. Homeowners, in the eyes of an insurer, are more settled. They're less likely to move suddenly. They have a mortgage to pay, which suggests a certain level of financial responsibility. This stability translates statistically into being a more reliable customer who pays their premiums on time and is less likely to file fraudulent claims. Renters, especially younger ones, are seen as more transient and therefore a slightly higher risk. Clicking homeowner can often shave a few percentage points off your premium. Your education level is another one of these socioeconomic data points. High school diploma, bachelor's degree, master's degree. It feels invasive, but the data shows that individuals with higher levels of education tend to file fewer claims. This is not a judgment on intelligence. It's a statistical correlation that insurers use to refine your risk profile. Someone with a PhD is, according to the data, a better insurance risk than someone who dropped out of high school. It's a cold, hard calculation based on broad population trends. Okay, so they've built a profile of you as a person. They know your age, your job, your home life. But now we get to the absolute core of the matter. The part of the application that can make or break your quote. Your driving history. This is where you have to come clean about every mistake you've made behind the wheel for the past 3 to 5 years. Progressive will ask you, in the last 5 years, have you had any accidents, claims, or traffic violations? This is the moment of truth. You have to be honest here because they are going to find out anyway. Before they give you a final bindable quote, they will pull your official motor vehicle report, or MVR, and your CLUE report, which is like a credit report for insurance claims. Lying here will only get your quote rejected, or your policy canceled later on. So let's break down what they're looking for. First, violations. A speeding ticket for going 10 miles over the limit is a minor infraction. It'll raise your rates for sure, but it's not a catastrophe. But a ticket for going 30 over in a school zone? That's a major red flag. A DUI or a reckless driving conviction? That's a 5-alarm fire. These are considered major violations, and they will send your premium into the stratosphere, or even make you uninsurable with a standard carrier like Progressive. They see a DUI not just as a mistake, but as a fundamental failure of judgment that makes you an unacceptable risk. Then there are accidents. The key distinction here is at fault versus not at fault. If someone ran a red light and T-boned you, it's a not at fault accident. While it might still slightly increase your rates in some cases, simply because being involved in any accident makes you statistically more likely to be in another one, the impact is minimal. But an at-fault accident where you were the one who caused it, that's a direct hit to your premium. It's concrete proof for the insurer that you have, in the past, cost them money. One at-fault accident in 3 years will cause a significant surcharge. 2 or more. You're now entering high-risk territory. They will also ask about something called In-State Route 22. If you don't know what this is, count yourself lucky. In-State Route 22 is not insurance itself, but a certificate of financial responsibility that a court or your state DMV forces you to get. It's typically required after a major conviction like a DUI or for driving without insurance. If you need In-State Route 22, you are telling the insurance company, the government has officially declared me to be a high-risk driver. The cost of your insurance will skyrocket, and many companies won't even offer you a policy. Every ticket, every fender bender, every claim is a data point that feeds the algorithm. It weighs the severity, it notes the date. A ticket from 4 years ago matters less than one from 4 months ago, and it calculates a risk score for you. This score, combined with all that demographic data, is what ultimately shapes the number you see on the screen. You've laid all your personal and driving cards on the table. You've given them a complete picture of you, the primary driver. But what if you're not the only one holding a set of keys in your house? What about your spouse, your teenage kid who just got their license, or your roommate who occasionally borrows your car? That's when the equation gets another layer of complexity, because their risk is now your risk. And that risk is precisely what the insurance company is trying to measure. When you land on the driver's page of the Progressive quote, you're moving from the who am I part of the equation to the who is my team part. Because make no mistake, from an insurance perspective, your household is a team, and every player's stats affect the entire team's score. The first and most important rule is this. You must list every licensed driver living in your household. This isn't a suggestion, it's a contractual obligation. It includes your spouse, your partner, your 25-year-old child who moved back home, and yes, the one you're dreading, your newly licensed 16-year-old. It also includes anyone not in your household who regularly drives your vehicle, like a nanny who uses your minivan to pick up the kids from school. Let's break down why this is so critical, starting with the most common addition, a spouse or partner. When you add them, you're essentially merging your driving identities. Progressive will pull their driving record, look at their accident history, and in most states, factor in their credit-based insurance score. If your partner has a squeaky clean record and great credit, congratulations, you just unlocked a potential discount. Your combined profile looks less risky, and you'll likely be rewarded for it. But the opposite is also true. If they have a couple of speeding tickets or a recent at-fault accident, your premium is going to reflect that shared risk. The insurer sees it as a doubling of the potential for a claim to be filed, and they have to price the policy accordingly. Now let's talk about the elephant in the room, the one that makes parents everywhere break into a cold sweat: the teenage driver. Adding a 16 or 17-year-old to your policy can feel financially catastrophic. Your premium can double, sometimes even triple overnight. And your first reaction is probably, "This is insane. How is this possible?" Here's the cold, hard data-driven truth. Teenage drivers, particularly males, are statistically the riskiest group on the road. They lack experience in judging speed and distance, they're more prone to distraction, and the unfortunate reality is they get into far more accidents per mile driven than any other age group. The insurance company isn't penalizing you. They are accurately pricing the colossal increase in risk that just got added to your policy. But don't despair. This is where understanding the system gives you power. When you add your teen, you'll be asked about their driving habits. Are they the primary driver of a specific car? Or will they just be an occasional operator of all the family vehicles? This matters. If you can assign them as the primary driver of the oldest, safest, most boring car you own, that 12-year-old Toyota Corolla, not the brand new Mustang, it can often result in a lower premium than just listing them as a general driver with access to everything. This is also the moment to hunt for discounts. Progressive will ask if your student maintains a B average or better. If they do, that's the good student discount, and it's a significant one. Why? Because data shows that students who are responsible in the classroom tend to be more responsible behind the wheel. Did they complete a certified driver's education course? That's another potential discount. Every little bit helps soften the blow. What about other people in the house, like a roommate? This is a gray area for many people. Let's say your roommate borrows your car once every 3 months to pick up a piece of furniture. That typically falls under what's called permissive use. Your policy will generally cover them in the event of an accident, just as it would a friend you let borrow the car for an afternoon. But what if your roommate's car is in the shop for a month, and they're using yours to commute to work every single day? That's no longer occasional permissive use. That's regular use. In that scenario, they absolutely must be listed on your policy. If they aren't, and they get into an accident, you could be facing a massive claim denial, leaving you personally on the hook for all the damages. This brings us to a powerful but dangerous tool: the excluded driver. Let's say that roommate has a DUI and 3 speeding tickets. Adding them to your policy would be financially ruinous. Progressive, and most insurers, will give you the option to specifically exclude that person from your policy. You are signing a document that says, "I acknowledge that John Smith lives in my house, but he will never, under any circumstances, drive my vehicles, and I understand that if he does, there is zero coverage." This can save you a fortune in premiums, but you have to be militant about it. If you let your excluded roommate borrow your car just once to go to the store, and they cause a 10-car pileup, your insurance will pay nothing. Not 1 cent. It's a tool to be used with extreme caution. So once you've identified everyone you need to add, the system will ask for their details: full name, date of birth, and driver's license number. That license number is the key. This isn't an honor system where you self-report your driving history. The moment you enter that number and click Next, Progressive system instantly pings a massive database, likely LexisNexis or a similar data aggregator, and pulls that person's complete motor vehicle report, or MVR. It's the official record from the DMV, showing every ticket, every violation, and every accident reported within the last 3 to 5 years, which is the standard look-back period for most insurers. This is why the next section, where it asks you to manually list any accidents or violations for each driver, is so important. And the number 1 non-negotiable rule here is, tell the truth. Do not omit that speeding ticket from 2 years ago, and don't try to fudge the details of that fender bender. They already know. The system has the MVR right in front of them. This section isn't just to see if you've had incidents. It's also a test of your honesty. If you lie and say you have a perfect record when the MVR shows 2 speeding tickets, that's called material misrepresentation. The best case scenario is they'll just correct the quote to the higher accurate price. The worst case scenario? They could issue the policy based on your false information, and then when you file a claim 6 months later, they'll do a deeper review, discover the lie, and deny your claim, possibly even canceling your policy back to its start date for fraud. It's a catastrophic risk, and it's never ever worth it. When you're entering this information, be specific. The form will ask for the date of the incident, what it was, a speeding ticket, an at-fault accident, a stop sign violation, and sometimes the cost of the damages. For accidents, the most important distinction is at fault versus not at fault. If you were rear-ended while stopped at a red light, that's a not-at-fault accident and will have little to no impact on your rates. But if you were the one who rear-ended someone else, that's an at-fault accident, and that's what triggers the premium surcharge. You've now built the human profile of your policy. You've told Progressive who is behind the wheel. You've disclosed their history, their experience level, and their relationship to you. You have assembled the cast of characters. Now it's time to give them their props. It's time to tell the insurance company what these people will be driving. And this is where the numbers game takes on a whole new dimension, because the vehicle itself is the other half of the risk equation. The difference in insuring a 15-year-old minivan versus a brand new, high-performance sports car isn't just a few dollars. It's a fundamental shift in the potential for a massive payout. We're moving from the drivers to the machines they command, and the vehicle section is up next. Alright, let's dive in. The very first thing Progressive asks is for the year, make, and model. But hold on, look right below that. There's a little link that says, Find Vehicle by VIN. This is the fast lane. This is the expert level move, and you need to understand why. The Vehicle Identification Number, or VIN, is your car's fingerprint. It's a 17-digit code that tells an insurance company more about your car than you probably know yourself. It's not just the make and model. It's the specific trim, the engine size, the factory-installed safety features, the country of origin, even the assembly plant where it was born. When you enter that VIN, Progressive system instantly cross-references it with massive databases. It pulls up the exact vehicle, eliminating any guesswork. It knows if you have the base model or the supercharged V8 performance package. It knows you have anti-lock brakes, side curtain airbags, and a factory-installed anti-theft system. This is crucial. Why? Because you might forget to mention those features later, and those are features that can earn you discounts. Using the VIN is like giving the insurance company a perfect, detailed blueprint of the asset they are about to insure. It's the single best way to ensure your quote is accurate from the very first click. But let's say you don't have the VIN handy. You're sitting on your couch, the car is in the garage, and you don't feel like getting up. That's fine. We'll go the manual route. You enter the year, let's say 2022, then the make Toyota, then the model Camry. But here's where most people trip up. The next field is body style or trim. It might seem insignificant. You might see options like LE, XLE, SE, TRD. And your first instinct might be to just pick the first one you see, the LE, the base model. This is a massive mistake. This single drop-down menu can swing your quote by hundreds of dollars a year. The difference between a base model Camry LE and the performance-tuned Camry TRD with its V6 engine, sport-tuned suspension, and more aggressive look is night and day to an insurer. The TRD has a higher replacement cost, higher repair costs due to specialized parts, and statistically, it's driven by people who enjoy a more spirited driving style. The insurance algorithm knows this. It sees TRD, and a little risk flag goes up. It sees LE, and it thinks reliable, predictable, standard risk. Be honest and be accurate here. If you don't know your exact trim, it's worth the 30-second walk to your car to look at the emblem on the trunk. Getting this wrong could mean you're either overpaying or worse, you're underinsured and don't even know it. Next up, a seemingly simple question. Do you own, finance, or lease this vehicle? This isn't just small talk. This is about identifying all the stakeholders. If you click Own, it means you hold the title free and clear. The car is 100% your asset. But if you click Finance or Lease, you've just told Progressive that another, very powerful entity has a vested interest in this car. A bank or a leasing company. This is the lien holder or lessor. And they have rules. Big ones. Think about it from the bank's perspective. They loaned you, say, $30,000 to buy that car. That car is their collateral. If you wreck it and you only have basic liability insurance, the bank gets nothing. Their $30,000 asset is now a pile of scrap metal. They're not going to let that happen. So your loan agreement or lease contract legally requires you to carry full coverage. That means both collision and comprehensive, with specific maximum deductible amounts, usually $500 or $1,000. When you select finance or lease, Progressive system knows this. It will often auto-populate your quote with these required coverages later on, because it knows you have a contractual obligation to have them. It's protecting you from violating your loan agreement, and it's acknowledging that the payout for a total loss won't just go to you. It will go to the bank first to pay off the loan. Now we get to the juicy stuff. What is this vehicle's primary use? The options are usually commuting, pleasure, or business/farm. Let's break down the psychology here. Pleasure sounds great, right? It implies you barely drive the car. It's for sunny weekends and trips to the ice cream shop. This is typically the lowest risk and therefore lowest cost option. But you have to be honest. If you drive that car to work even just once or twice a week, that's a commute. Commuting is the most common answer. You're telling the insurer that the vehicle will be on the road during the most dangerous times of day, morning and evening rush hour. You're in stop-and-go traffic, surrounded by other stressed-out drivers. It's a predictable daily risk and the rate reflects that. They'll then ask for the one-way distance to work. Don't think a 5-mile commute is the same as a 50-mile commute. That's 10 times the exposure to risk every single day. Then there's the third option. Business. This is the big one. The moment you click this, you're entering a different universe of risk. It's no longer just about you getting to an office. It could mean you're a real estate agent showing houses, a salesperson visiting clients, or a contractor hauling tools and materials. You're not just driving, you're performing a job with the vehicle. The mileage is higher, the cargo might be valuable or hazardous, and the potential for a catastrophic liability claim skyrockets. If you're a pizza delivery driver and you get into an accident, it's not just a personal fender bender, it's a workplace accident. Progressive needs to know this because a standard personal auto policy often excludes or severely limits coverage for business use. Selecting this option will likely trigger a follow-up or even guide you toward a commercial auto policy, which is exactly what you need to be properly protected. Lying here is one of the fastest ways to have a claim denied. Tied directly to this is the next question. Estimated annual mileage. This is the odometer oracle. It's a pure, unfiltered measure of your car's time on the battlefield. More miles equals more time on the road, which equals a higher probability of an incident. It's that simple. People are often tempted to lowball this number. They think, how would they know? I'll just put 5,000 miles. Be careful. Insurance companies have access to more data than you think. They get vehicle history reports from services like Carfax. They get odometer readings from state inspections and emissions tests. If you file a claim 2 years from now and your odometer reading is wildly inconsistent with the mileage you claimed on your policy, it can raise red flags. The best way to estimate this is to look at your average from past years. Check your last 2 service records or state inspection reports, see how many miles you drove in that year, and use that as your honest baseline. Finally, the system will confirm the garaging address. This is a stealthy but incredibly powerful rating factor. It asks, where is this vehicle usually parked overnight? This might be the same as your mailing address, but not always. You might be a student living in a dorm 9 months a year. The car sleeps at the dorm, not at your parents' house. Why does this matter so much? Because every zip code in America has its own risk score. Insurers analyze decades of data on a hyperlocal level. They know the rate of vehicle theft, vandalism, hailstorms, flooding, and collision frequency block by block. Parking your car in a quiet, suburban garage with low crime rates is a much lower risk than parking it on the street in a dense urban center with high theft rates. It's not personal, it's purely statistical. Your location and the environment you park in directly impact the likelihood that Progressive will have to pay out a claim for something other than you crashing it. So in just this one section, we've defined the asset itself in painstaking detail, from its performance trim to its financial obligations. We've told the story of its daily life, its commute, its purpose, its annual journey. And we've established its home base, the environment where it rests and is most vulnerable. We've built a complete risk profile for the machine. And with that profile locked in, we're ready to move to the most critical part of this entire process, the part that determines what actually gets paid when things go wrong. We're about to build our shield. We're heading into coverages. This is where the rubber meets the road. Forget everything else for a moment. This single screen is the heart of your policy. It's not a list of options. It's a series of decisions that will echo for years if you're ever in a serious accident. What we do here isn't about saving $5 a month. It's about protecting your house, your savings, your future. It's about building a financial fortress around your life. Let's start with the first and most important layer of that fortress: liability coverage. This is the big one. And here's the number one mistake people make. They think this coverage is for them. It's not. Liability coverage has absolutely nothing to do with fixing your car or paying for your medical bills. This is the money your insurance company will pay to other people when an accident is your fault. It's your shield against their lawsuits. You'll see 2 parts here: bodily injury and property damage. Let's break it down. Bodily injury liability is for the people you might hurt. Their ambulance ride, their hospital stay, their surgeries, their lost wages because they can't work, even their pain and suffering. Progressive, like most insurers, displays this with two numbers separated by a slash, like 100-300. This looks like confusing code, but it's simple. The first number, 100, stands for $100,000. That's the maximum amount your policy will pay for any single person's injuries in an accident you cause. The second number, 300, stands for $300,000. That's the maximum total amount your policy will pay for all injuries combined in that single accident. So if you hit a car with 3 people in it, you have a $300,000 pot of money to cover their medical bills. But you can't give more than $100,000 to any one of them. Now you'll see the state minimums here. They might be something terrifyingly low like $2,550, $25,000 per person, $50,000 per accident. Let me be crystal clear. Choosing state minimum liability is one of the most dangerous financial gambles you can take in your life. One single night in an American hospital can cost more than $25,000. A single broken bone with surgery can obliterate that limit. And what happens when the bills exceed your coverage? They don't just disappear. The other party's lawyer won't just shrug and say, "Oh well." They will come after you. Personally. They will sue you for your savings, your investments. They can put a lien on your house, and in many states they can garnish your future wages for years, even decades to come. All because you tried to save a few bucks a month. My advice, and the advice of nearly every financial expert, is to get the highest liability limits you can possibly afford. 100 of 300 is a good starting point. 250 to 500 is even better. It is the cheapest peace of mind you will ever buy. Next is property damage liability. This is the third number in that sequence, so if you see 100/300/100, that last number is $100,000 for property damage. This covers the stuff you break. The other person's car is the obvious one, but it also covers the lamppost you knock over, the storefront you crash into, the fence you run through. Again, the state minimum might be a paltry $10,000 or $15,000. Think about the cars on the road today. The average new car costs over $45,000. A new truck or luxury SUV, $60,000, $70,000, $80,000 is common. If you total someone's brand new Ford F-150 with a $15,000 property damage limit, you are personally on the hook for the other 50 or 60 grand. You just can't risk it. A limit of $100,000 is the modern-day minimum for being a responsible driver. Okay, so that's the shield that protects you from others. But what happens when the person who hits you has no shield? What if they're one of the estimated 1 in 8 drivers in America who is illegally driving with no insurance at all? Or what if they did the irresponsible thing and only have the state minimum, and your medical bills are 10 times that amount? That's where this next section comes in. Uninsured and underinsured motorist coverage. This is your backup shield. It is coverage you buy to protect yourself from the irresponsibility of others. It steps in and acts like the other driver's insurance when they don't have any, or don't have enough. Uninsured motorist bodily injury pays for your medical bills, your lost wages, your pain and suffering when you're hit by someone with no insurance. Underinsured motorist kicks in when the at-fault driver has insurance, but their low-level liability limits run out before your bills are paid. Your policy covers the rest, up to the limit you choose. Here's a simple rule of thumb. Your uninsured and underinsured motorist limits should always match your liability limits. Think about it. If you believe you need $250,000 to protect a stranger from injuries you might cause, why on earth would you give yourself and your family less protection than that? It makes no sense. You are just as valuable as the person you might hit. Protect yourself accordingly. Some states even offer uninsured motorist property damage, which helps pay to fix your car if an uninsured driver hits you. It's a fantastic and often cheap addition. Now we move from the catastrophic to the immediate. Medical payments coverage, or in some states, personal injury protection or PIP. Think of this as your personal accident medic. This is a small pot of no-fault medical coverage, usually in amounts like $500, $1,000, or $5,000. The key phrase is no fault. It doesn't matter who caused the accident. This money is available to you and your passengers immediately to pay for initial expenses. Ambulance rides, emergency room copays, your health insurance deductible, dental work if your teeth get chipped. It's fast cash to handle the immediate aftermath without waiting weeks or months for a fault decision to be made. Even if you have great health insurance, this is incredibly valuable for covering those out-of-pocket costs right away. For the few dollars a month it costs, it's almost always worth getting. Alright, we've built the shield to protect you from lawsuits and irresponsible drivers. We've hired the medic for immediate injuries. Now it's time to put the armor on your car itself. This is what most people call full coverage, and it's made up of two separate parts: collision and comprehensive. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a tree, a guardrail, or a pothole that you hit. It doesn't matter who is at fault. If you cause the crash, or if it's a hit and run, or if you just lose control on an icy road and hit a pole, collision is what fixes your vehicle. Comprehensive coverage is sometimes called other than collision. It's the armor for almost everything else. All the chaos life can throw at your car that isn't a crash. If a tree branch falls on your car during a storm, that's comprehensive. If a deer jumps out in front of you, that's comprehensive. If your car is stolen, vandalized, or catches on fire, that's comprehensive. Hail damage that turns your hood into a dimpled mess? Comprehensive. For both collision and comprehensive, you have to choose a deductible. The deductible is the single most important number in this section. It is the amount of money you agree to pay out of pocket for a repair before the insurance company pays a single dollar. A common deductible is $500 or $1,000. So if you have a $1,000 deductible and you get into an accident that causes $8,000 of damage to your car, you pay the body shop the first $1,000. Your insurance company then pays the remaining $7,000. The trade-off is simple. A higher deductible, like $1,500, means you're taking on more personal risk, so the insurance company will give you a lower premium. A lower deductible, like $250, means the insurance company is on the hook for more, so your premium will be higher. The right choice depends on your emergency fund. You should never choose a deductible that's higher than what you could comfortably write a check for tomorrow without breaking a sweat. For most people, a $500 or $1,000 deductible strikes the right balance between a manageable premium and a manageable out-of-pocket expense. We have now officially built the core of your policy. We've constructed the liability shield to protect your assets, the uninsured motorist shield to protect you from others, and the physical armor of comprehensive and collision to protect your car itself. This is the foundation. But we're not done. The foundation is strong, but a fortress needs more than just walls. Next, we're going to look at the optional coverages, the special features that can turn a good policy into a great one, the things that make a nightmare scenario merely an inconvenience. We're about to add the tools and provisions to our fortress. And the first tool we're grabbing for our utility belt is roadside assistance. Now I know what you're thinking. You might already have this through your cell phone provider, a credit card, or a motor club membership. And if you do, great, maybe you can skip this. But for a few extra dollars a month, Progressive's version is incredibly convenient and comprehensive. Let's paint a picture. It's midnight. You're on a poorly lit back road, miles from the nearest town, and you hear that dreaded thump thump thump. A flat tire. Or worse, you see steam pouring from under the hood. Or you just absent-mindedly locked your keys in the car at a gas station. In that moment of panic, are you going to start Googling for a tow truck, hoping you find a reputable one that won't charge you a fortune? Are you going to dig through your wallet for that motor club card you haven't seen in a year? Or do you want to just open the Progressive app, press one button, and know that help is on its way with the cost already covered? That's the difference. It's not just about towing. It's winching if you're stuck in mud or snow, fuel delivery if you run out of gas, a jump start for a dead battery, and lockout services. For the cost of a fancy coffee once a month, you're buying peace of mind. You're buying a get-out-of-jail-free card for some of the most common and frustrating car problems. In my opinion, unless you have a premium motor club membership you absolutely love, this is one of the easiest and most valuable additions you can make. Next up is rental car reimbursement. This is one of those coverages that seems like a luxury until the day it becomes an absolute necessity. Let's be brutally honest. After a covered accident, your car isn't going to be fixed in an afternoon. The average repair time for even moderate damage can be a week, 2 weeks, sometimes even longer, depending on parts availability and how busy the shop is. Now ask yourself, how would your life function without a car for 2 weeks? How do you get to work? How do you take your kids to school, to soccer practice, to the doctor? How do you get groceries? Suddenly, you're looking at a daily bill for a rental car, which can easily be $50, $60, even $70 a day. Over 2 weeks, you could be looking at a bill close to $1,000, all out of your own pocket, right after you've already had the stress and expense of an accident. That's a financial gut punch when you're already down. rental reimbursement coverage prevents this. For a very small premium increase, Progressive will cover the cost of a rental car up to a certain daily limit, say $40 or $50 a day, for up to 30 days. When you're getting the quote, you'll see the options. My advice? Look up the cost of a basic rental car in your area and pick the daily limit that actually covers it. Choosing the $30 a day option to save $1 a month is pointless if a rental actually costs $50. This coverage is the bridge that allows your life to continue with minimal disruption while your car is being put back together. It transforms a major life-halting catastrophe into a manageable inconvenience. Now let's talk about one of the single most important optional coverages for anyone who has a loan or a lease on their vehicle. This is loan/lease payoff, but you probably know it by its more common name, gap insurance. If you are financing or leasing your car, you need to listen very, very closely. Cars depreciate. The second you drive a new car off the lot, it loses a significant chunk of its value. This depreciation continues every single day. The problem is, the amount you owe on your loan or lease doesn't drop nearly as fast. This creates a gap between what your car is worth, its actual cash value, and what you still owe on it. Let's say you owe $18,000 on your car loan, but due to depreciation, the car's market value, its actual cash value, is only $15,000. If your car is stolen or totaled in an accident, your comprehensive or collision coverage will pay out what the car is worth. They will write you a check for $15,000, but you still owe the bank $18,000. That means even after the insurance payout, you are personally on the hook for that $3,000 difference. You will be forced to continue making payments on a car that no longer exists. It is a financial nightmare. Gap insurance is designed specifically to cover this gap. It pays that difference between the insurance payout and your remaining loan balance. If you put a small down payment on your car, or if you have a loan term longer than 48 months, you are almost certainly upside down and need this coverage. It is an absolute financial lifesaver that prevents a total loss of your vehicle from becoming a total financial catastrophe for you. Okay, let's shift gears. What if you're someone who loves your car? Not just as a tool, but as a hobby. You've upgraded the wheels, put in a killer sound system, maybe added a custom paint job or a performance exhaust. You've invested thousands of dollars to make your car uniquely yours. You need to know that your standard policy does not cover these upgrades. If your car is in an accident, the insurance company values it based on its factory condition. They don't care about your 10-speaker, dual subwoofer sound system, or your $2,000 custom rims. They will pay to replace them with stock factory-grade parts, and that's it. All that money you invested, gone. That's where custom parts and equipment, or CPE coverage, comes in. This is an add-on that specifically protects your aftermarket modifications. You can typically buy coverage in increments of $1,000, up to a total of $5,000. So if you've put $3,000 into your car, you buy $3,000 in CPE coverage. Then, if your car is damaged or stolen, the value of those custom parts is included in the settlement. It's a crucial addition for any enthusiast who has personalized their ride. Without it, you're essentially gambling with your investment every time you drive. Now for a couple of features that are unique to carriers like Progressive, designed to reward good drivers. First is the deductible savings bank. This is a brilliant little feature. Remember, your deductible is the amount you pay out of pocket before insurance kicks in. A $500 deductible means you pay the first $500 of a repair. What Progressive does is reward you for safe driving. For every claim-free policy period, that's typically 6 months, they will subtract a certain amount, usually $50, from your collision and comprehensive deductible. It's like they're putting $50 into a savings account for you. So after your first 6 months of safe driving, your $500 deductible effectively becomes $450. After a year, it's $400. And it keeps going down until it hits zero. That's right, you can earn a $0 deductible just by not having an accident. This is a fantastic loyalty perk. It means that if you do eventually have a claim after years of safe driving, your out-of-pocket costs could be significantly less, or even nothing at all. It's a tangible reward for being the kind of customer they want to keep. And that brings us to the ultimate reward: accident forgiveness. This is the one everyone asks about. We all live with that low-level fear that one tiny mistake, a moment of distraction, a fender bender in a parking lot, is going to cause our insurance rates to skyrocket for the next 3 to 5 years. Accident forgiveness is the shield that protects you from that. Now, Progressive has a couple of levels. Small accident forgiveness is often included from day one. It means that if your first claim is for a small amount, typically under $500, your rate won't go up. It's a nice little buffer for a scraped bumper or a cracked taillight. But the real prize is large accident forgiveness. This is something you earn. After you've been a Progressive customer for a certain number of years and have remained accident-free for a consecutive period, they grant you this status. And it means that your rates won't increase after your first at-fault accident, no matter how large the claim is. You could cause a $20,000 accident, and as far as your premium is concerned, it never happened. This is an incredibly powerful benefit. It removes the constant anxiety of a single mistake costing you thousands of dollars in surcharges over the years. It allows you to have a bad day without it turning into a multi-year financial penalty. It's the ultimate expression of a company rewarding a loyal, safe driver. So we've armed our fortress. We've added roadside assistance for when we're stranded, rental reimbursement to keep our lives moving, gap insurance to protect our finances from total disaster, and special coverages for our custom gear. We've even unlocked rewards that lower our future costs and forgive our mistakes. Our policy is now a comprehensive shield, customized to our exact needs. But building the perfect fortress is only half the battle. The other half is getting it for the best possible price. The price you see on the screen right now is not the final price. Not even close. Now we begin the hunt. We are about to go through this quote with a fine-tooth comb and apply every single discount we are eligible for. Some of them you know about, but I guarantee you there are some you've never even heard of that could save you hundreds of dollars. It's time to slash this premium. Alright, let's dive in. On the main quote page, you'll see a section, usually right near the price, that says something like Ways to Save or View Discounts. That's our target. We're clicking that, and it's going to open up a whole new world of savings that Progressive has provisionally applied, and more importantly, ones it hasn't. The first thing you'll notice is that some discounts are probably already checked off. For John, the multi-policy discount is active. This is one of the big ones, folks. If you have renters, homeowners, or even condo insurance, you should always bundle it with your auto. Insurers give you a massive price break for this, not just because they want more of your business, but because statistically, people who own property are seen as more stable and less of a risk. It's a sign of responsibility in their eyes. For John, we bundled his home insurance, and you can see it's saving him a significant amount right off the bat. If you didn't do this on the first screen, you can usually add it here. Don't leave this money on the table. Next up, the multi-car discount. We have 2 vehicles on this policy, so that's another automatic win. The logic is simple. They want to be the insurer for your whole family, for every car in your driveway. By giving them all your business, you become a more valuable customer, and they reward you for it. It's cheaper for them to manage one policy with 2 cars than 2 separate policies. Now let's get into the discounts we have to actively select. This is where the real treasure hunt begins. Let's look at the payment options. You'll see a discount for Pay in Full. This is a no-brainer if you can swing it. If you have the cash available to pay for the entire 6-month or 1-year policy upfront, do it. Insurance companies love this. It guarantees them their money, eliminates the risk of you missing a monthly payment, and drastically cuts down their administrative and billing costs. Because they save money, they pass a chunk of those savings on to you. For a policy costing, say $1,000 for 6 months, this discount alone could be $50 to $100. That's an incredible return on your money just for paying early. If paying in full isn't an option, don't worry. The next best thing is automatic payments. By letting Progressive automatically deduct the payment from your bank account or credit card each month, you're again reducing their risk and administrative overhead. They don't have to worry about a check getting lost in the mail, or you forgetting to log in and pay. It's a smaller discount than paying in full, but it's still free money. We're selecting that for John. Right below that, you'll almost always see a paperless discount. Click it immediately. In this day and age, there is almost no reason to get paper statements mailed to you. It costs the company money for printing, envelopes, and postage. By going paperless, you save them that cost and they give you a discount. It's better for the environment, it clutters your house less, and it saves you money. This is one of the easiest discounts in the entire insurance world to get. Okay, now we're getting into the driver-specific discounts. This is where knowing the details about everyone on your policy is crucial. First, good student. Do you have a driver on your policy who is in high school or a full-time college student and maintains good grades? Typically, this means a B average or a 3.0 GPA. So, you need to check this box. John's daughter, Sarah, is a sophomore in college and a great student. We're checking this. Now be prepared, they will ask for proof. You'll likely need to upload a copy of a recent report card or a college transcript. It's a small bit of effort for what can be a very significant discount, sometimes as much as 10 to 15%. Why? The data shows a strong correlation between being a responsible student and being a responsible driver. It's all about risk reduction. What if your student goes to college far away? Look for the distant student or student away at school discount. If the college is more than 100 miles from your home and the student doesn't have a car with them on campus, you can get a huge discount. The insurer knows that the student will only be driving the car when they're home for holidays or summer break, meaning the vehicle is sitting unused most of the year. Less time on the road means drastically less risk. This is a big one that many parents overlook. Now for a discount that a lot of people think is just for teenagers: defensive driving. If you or any driver on your policy have taken an approved defensive driving course in the last few years, you can get a discount. These courses are often available online, they're not very expensive, and they can take a few percentage points off your premium for up to 3 years. It's especially valuable for older drivers, as some states mandate that insurers provide a discount for seniors who complete an approved accident prevention course. It's worth a quick search to see what courses are approved in your state. A few hours of your time could translate into a couple $100 in savings over the life of the discount. Okay, let's talk about a discount that sounds obvious but has a hidden layer: the homeowner discount. You might be thinking, wait, I already got the multi-policy discount for bundling my home insurance. And you'd be right. But here's the secret. Even if you don't insure your home with Progressive, you can still often get a discount just for being a homeowner. If you own a house, a condo, or even a mobile home, you should select this. Again, it comes back to statistics. Homeowners tend to be more financially stable and are statistically less likely to file auto insurance claims compared to renters. They see you as a lower-risk client just based on the fact that you own property. So even if your home is insured with a completely different company, you need to make sure you're telling Progressive you're a homeowner. It's a frequently missed opportunity. Here's another one that's incredibly important and often misunderstood: continuous insurance. Progressive wants to know if you've had continuous auto insurance coverage with no gaps or cancellations. They might ask how long you were with your previous carrier. The longer, the better. If you've been continuously insured for the last 5 years without any lapse in coverage, that tells them you are a responsible, consistent customer. A driver who lets their insurance lapse is a massive red flag for an insurer. It suggests financial instability or a lack of foresight, both of which translate to higher risk. If you've been a loyal customer to another company, Progressive wants to reward you for that stability and win your business. Don't lie about this, they can and often do verify it, but be sure to claim it if it applies to you. Finally, we arrive at the most debated, most powerful, and potentially most lucrative discount of them all: Snapshot. This is Progressive's telematics program. By agreeing to this, you're allowing Progressive to monitor your driving habits. This can be done through a small device you plug into your car's OBD2 port, or more commonly now, through their smartphone app. The app runs in the background and uses your phone sensors to track things like hard braking, rapid acceleration, late-night driving, and total mileage. Now, a lot of people are immediately put off by the privacy implications, and that's a valid concern. You are giving them a direct window into your driving behavior. But let's break down the financial reality of it. First, Progressive gives you an initial discount just for signing up. It's a thank you for participating. That's money you get right away before you've even driven a single mile. Then, over the next few months, it collects data. The safer you drive, the bigger your final discount will be when it comes time to renew your policy. Progressive says good drivers can save an average of over $200 a year. However, and this is critical, in most states it can also raise your rates. If the data shows you're a risky driver, you're constantly slamming on the brakes, driving at 2 a.m., or using your phone while driving, your premium could actually go up at renewal. So Snapshot is a calculated gamble. If you are genuinely a safe, conscientious driver who doesn't do a lot of late-night driving, it can be an absolute goldmine of savings. If you have a lead foot or a long commute that often results in hard braking in traffic, you might want to think twice. For John, who has a predictable commute and considers himself a safe driver, we're going to select it. We'll get that initial discount now, and he's confident his good habits will lead to an even bigger one at renewal. Okay, we've gone through the list. We've selected automatic payments, paperless billing, good student, homeowner, and we've enrolled in Snapshot. Each click has been chipping away at that initial premium. Now for the moment of truth. Let's hit the update or recalculate button and see the combined power of all these discounts we just unearthed. The page is refreshing and there it is. The premium has dropped, and not by a small amount. We've managed to shave a very significant chunk off the top, turning a decent quote into a fantastic one. This is the power of spending just 10 extra minutes methodically going through every single option. But we're not quite done yet. The price is locked in, but now we have to navigate the final pages, confirm our information, and make this policy official. And there are still a couple of potential pitfalls to avoid right at the finish line. Okay, so here we are. The final boss level. You've tweaked the coverages, you've hunted down every last discount, and you've stared at that final price until it burned itself onto your retinas. This is the point where most people's brains switch to autopilot. You're tired, you've made 100 tiny decisions, and you just want to click purchase and be done with it. And that, right there, is the most dangerous moment of this entire process. Because the insurance company knows this. The final pages are designed for speed, for quick clicks, for you to just gloss over everything because you feel like the work is already done. But it's not. This is the measure twice, cut once part of the job, and we are going to measure with the precision of a Swiss watch. Let's start with the very next screen you'll likely see. The final details, or review your information page. It looks harmless. It's just a summary of your name, your address, your date of birth, and the VINs of your vehicles. Your eyes will scan it, see that it looks vaguely correct, and your hand will instinctively move to the Continue button. Stop. Take your hand off the mouse. Now read every single line. Out loud. I'm serious. Read your own name out loud. Is it spelled correctly? Is the middle initial there if it's on your driver's license? Now read your address. Is it street or avenue? Is the zip code right? A single digit off can send your official documents, your proof of insurance, to a completely different town. This isn't just about getting mail. In the event of a claim, if the information on your policy doesn't perfectly match your legal identification, it can create a bureaucratic nightmare of verification and delays, right when you need help the most. But the absolute, positively most critical piece of information on this page is the vehicle identification number, the VIN. You need to treat this 17-digit code like it's the launch code for a nuclear submarine. Do not assume it's correct just because you entered it correctly earlier, or because it was autofilled. Go outside. Right now if you have to. Take your phone, walk to your car, and take a picture of the VIN plate on the driver's side dashboard or the sticker on the inside of the door. Come back and compare it character by character. Why am I so obsessed with this? Because if that VIN is wrong, you are not insuring your car. You are insuring a phantom vehicle that happens to have a similar make and model. If you get into an accident and the police officer, the tow truck driver, or the claims adjuster runs your VIN and it doesn't match the policy, for all intents and purposes, you are uninsured. It's a catastrophic yet completely avoidable error. Check it. Then check it again. Once you've confirmed that you are, in fact you, and your car is, in fact your car, you'll proceed to the payment page. And here lies the next major decision point, disguised as a simple transaction. You'll be presented with payment options. Typically pay in full or pay monthly. Now the pay in full option will almost always be cheaper. Progressive, like all insurers, will give you a discount for giving them all the money up front. It's a cash flow win for them and they pass a small part of that benefit to you. But you need to do the math. Don't just look at the discount and jump. Let's say the 6-month policy is $600 if you pay monthly, at $100 a month. The pay in full option might be $570. You're saving $30. Is having that extra $570 in your bank account for the next 6 months worth more to you than $30? For some people, absolutely. For others, the savings and the peace of mind of not having another monthly bill is well worth it. There's no single right answer, but you must make an active choice. Don't just default to the monthly plan because it's easier in the moment. Consider the long-term value. And then how you pay matters. You'll see options for EFT, or electronic funds transferred directly from your bank account, and credit or debit card. Pay close attention here. Often there's a small processing fee, or convenience fee, for using a credit card. Maybe a few dollars per transaction. If you're paying monthly, that could add up to $20 or $30 over the policy term, completely wiping out a discount you worked so hard to get. EFT is usually free. If you're comfortable with it, it's almost always the cheaper option. Another pro tip for monthly payments. Progressive will let you choose your withdrawal date. Do not just accept the default date. Line it up with your payday. If you get paid on the 1st and the 15th, Set your insurance to come out on the 3rd or the 16th. This simple act of calendar management dramatically reduces the risk of an accidental overdraft or a late payment, which can trigger late fees and, in a worst-case scenario, a policy cancellation. You've verified your info, you've chosen your payment plan. Now comes the wall of text. The terms and conditions, the policy agreement, the e-signature page. This is the digital equivalent of a stack of papers being slid across a desk with a pen on top and a smiling agent saying, "Just sign here, here, and here." We're not doing that. You are about to enter into a legally binding contract. You need to have a fundamental understanding of what you're agreeing to. Now, I'm not saying you need to read all 40 pages of the policy jacket, but you absolutely must find, download, and review your declarations page. This is the holy grail. It's the 1 or 2 page summary of your entire policy. It lists the name of the insured, the policy period, every vehicle, every driver, and most importantly, a clear itemized list of your coverages and their corresponding premiums. This is your final check. Scan down that declarations page. Are the liability limits exactly what you selected? Is the comprehensive deductible $500 just like you wanted? Is the collision deductible $1,000? Is rental reimbursement on there? Did the roadside assistance you added actually get included? You'd be shocked at how often a system glitch or a misclick can change something between the quote screen and the final contract. This is your last chance to catch it before it's locked in. Find this document. It might be a button that says View Policy Documents or Review Your Policy. Click it. A PDF will open. Save this PDF to your computer and your phone immediately. Do not wait for them to email it to you. Do not assume you can find it later. Download it now. This document is your proof of purchase and your contract. Treat it like gold. Once you have that declarations page saved and you've given it one last review, you can finally proceed. You'll enter your payment information, check the box that says, "I agree," and you will click that final glorious button, Submit Payment or Purchase Policy. And that's it. A wave of relief washes over you. A confirmation number appears on the screen. An email instantly hits your inbox with the subject line, "Welcome to Progressive." You'll see links to download your digital insurance ID cards. Do it immediately. Screenshot them. Save them to the files on your phone. Put them in an album. You want to be able to access these in 10 seconds or less, even with no internet connection. You did it. You are officially insured. You've navigated the entire labyrinth from the first anonymous quote to the final binding signature. You've been smart, you've been diligent, and you've likely saved yourself a significant amount of money and future trouble. You can take a deep breath and pat yourself on the back. But your journey to becoming a truly empowered policyholder isn't quite over. Because what you do in the next 24 hours is just as important. What do you do with these new documents? What should you print and put in your glove box? And how can you leverage the Progressive app to make your life infinitely easier? Getting the policy is just step 1. Now we need to learn how to use it. Alright, you've done it. You've navigated the maze of coverages, you've hunted down every last discount, you've signed on the digital dotted line, and you are officially insured with Progressive. Congratulations! But as that confirmation email hits your inbox, filled with links and attachments, a new question pops up. Now what? You have this digital mountain of paperwork, this brand new policy. How do you turn it from a bunch of files on a screen into a tool that actually protects you? Let's start with that initial flood of documents, often called your welcome packet. Think of it as the instruction manual for your new financial safety net. Tucked inside, you're going to find 3 critical pieces of paper, or their digital equivalents. First, and most importantly, is your declarations page, or the deck page. If you only understand one document, make it this one. The deck page is the one-page summary of your entire policy. It is the absolute heart of your contract. It lists your name, your address, your policy number, and the exact dates your coverage begins and ends. It lists every vehicle you have insured, identified by its VIN. It lists every driver covered under the policy. And crucially, it itemizes every single coverage you selected: bodily injury, property damage, uninsured motorist, comprehensive, collision, along with the exact dollar limits or deductibles for each. This is your proof. This is the cheat sheet. When you have a question about what you're paying for, you don't need to read the 50-page policy booklet. You start with the deck page. It's the receipt for your protection. Next up, you'll find your insurance ID cards. These are your golden tickets. This is the document law enforcement will ask for if you're pulled over. and what you'll exchange with another driver in the unfortunate event of an accident. You will typically get a document with a few cards on a single sheet. The first thing you should do right now is print this page. Cut out at least 2 cards. Put one in the glove box of each car on your policy. Don't just leave it on the passenger seat. Don't tuck it in the sun visor. Put it in the glove box with your vehicle registration. Make it a habit. This is non-negotiable. The third document is the big one, the policy contract itself. This is the multi-page, text-heavy legal document. And let's be honest, almost nobody reads this cover to cover. It's filled with legal definitions, exclusions, and specific conditions. But that doesn't mean it's useless. Think of it as the ultimate rule book. You don't need to memorize it, but you should save a digital copy in a safe place on your computer or in the cloud. Why? Because if you ever have a really specific question, like is my custom stereo system covered? Or what happens if a tree branch falls on my car during a storm? The detailed answer is in this contract. The deck page tells you that you have comprehensive coverage. The policy contract tells you exactly what comprehensive means according to Progressive, and what specific situations are included or excluded. Now, managing these documents, remembering your payment schedule, and knowing who to call can feel like a chore. And this is where we fulfill the promise from the last section. This is how we make your life infinitely easier. We're going to talk about the Progressive app. If you do nothing else after watching this video, download the app to your smartphone and log in. This little icon on your phone is the command center for your entire policy. It takes all that paperwork and complexity and transforms it into a simple, powerful tool. The moment you log in, you'll see a dashboard. It's designed to give you the most important information at a glance. Your policy status, your next payment amount and due date, and quick links to your most used features. And the first feature you should notice is your digital ID card. Remember that paper card we just put in your glove box? The app has a digital version, accessible with a single tap. Many states now legally accept digital proof of insurance, but even if you prefer to have the physical copy, this is an incredible backup. Imagine you're in an accident, your glove box is jammed, or you're in a friend's car and need your policy info. Instead of panicking, you just pull out your phone. It's instant peace of mind. Next, let's talk about managing your policy. Life happens. You move to a new apartment, you get a new phone number, or you buy a new car. In the old days, each of these events meant a phone call to your agent, waiting on hold, and hoping their office was open. With the app, you become your own agent, available 24/7. Let's play out a scenario. It's Saturday afternoon. You've just spent hours at a dealership and you've found the perfect car. You're ready to buy it and drive it off the lot, but your insurance agent's office closed at noon. What do? You open the Progressive app. You tap on Add a Vehicle. You scan the VIN number right from the sticker on the car. The app pre-fills the year, make, and model. You select the coverages you want, mirroring what you had on your old car or choosing new ones. The app calculates the change in your premium instantly. You confirm the change, and in less than 5 minutes, your new car is insured. You can immediately access a temporary ID card with the new vehicle on it. You are legally covered before the dealership even finishes your financing paperwork. That is power. That is control. The same goes for adding a new driver, say a teenager in your household who just got their license, or changing your address. You can do it all yourself on your own time. Of course, the real reason you have insurance is for when things go wrong. Filing a claim is the moment of truth. And it's a moment that is almost always stressful, chaotic, and emotional. The app is designed to bring calm and order to that chaos. If you're in an accident, after ensuring everyone is safe and calling 911 if necessary, you can open the app and start a claim right there at the scene. It will guide you step by step. You'll input the date, time, and location. You can use your phone's camera to take pictures of the damage to both vehicles, the license plates, the other driver's information, and the overall scene. You can write or even record a voice note describing what happened while it's fresh in your mind. By the time you get home, a claim number has already been assigned and the process has begun. You've taken the first, most important step in getting your life back to normal, all from the palm of your hand. And remember that roadside assistance coverage we talked about adding? The app is how you use it. If you get a flat tire, run out of gas, or your car won't start, you don't need to Google a local tow truck company and hope you find a good one. You open the app, tap roadside assistance, and it uses your phone's GPS to pinpoint your exact location. You tell it what the problem is, and it dispatches a pre-approved service provider to you. There's no fumbling for a policy number, or trying to describe a street corner you don't recognize. It's one button, help. So now you have the documents and you have the app. Your policy is active. You're set, right? Almost. The final step is proactive management. Insurance is not something you set and forget forever. Your life changes and your insurance needs change with it. Set a calendar reminder for yourself for 30 days before your policy is set to renew in 6 months or a year. When that reminder pops up, it's your prompt to do a quick policy review. Have your circumstances changed? Did you get a new job with a much shorter commute? Did you pay off your car loan? Maybe you no longer need such a low comprehensive deductible on an older car. This is your chance to reevaluate. It's also your chance to quickly shop around again with that renewal price in hand to ensure Progressive is still the best value for you. A smart consumer is an active consumer. This journey, from the very first screen of the quote to downloading the app, has been about one thing: empowerment. It's about demystifying the process so you're not just clicking buttons but making informed decisions. You learned how to choose the right liability limits to protect your assets. You discovered how to balance deductibles and premiums to fit your budget. You uncovered discounts you might not have known existed. And now, you know how to manage your policy like a pro. You're not just someone who pays an insurance bill. You are an educated, empowered driver who is in complete control of your financial protection. And that is a feeling that is worth every bit of the effort.